Hi, everyone. Thank you for coming. My name is Hope Rostrabaldi. I'm the Community Engagement Manager with Valley Venture Mentors in Springfield, Mass. We're so lucky to have Katishia Gallishaw here today to do a workshop on bookkeeping 101, very important topic for entrepreneurs. Katishia is an accounting professional with nearly 20 years of experience in companies ranging from startups to Fortune 100 to nonprofits and religious organizations. She's also active in community organizations, serving as a mentor and tutor in the Springfield Public Schools, and participates on various boards and advisory councils. She holds a BSBA and MS in accounting from Western New England University and a Master of Arts in Spiritual Formation from Gordon Conwell Theological Seminary. As CEO and co-founder of KG Virtual CFO, Katishia is committed to supporting its clients and reaching their goals. Thank you so much for joining us tonight.
Thank you so much for having me, Hope. Glad to be here and glad to share some time with some wonderful business owners on tonight. And you want me to get going? Sure. Okay, cool. Let me see if I can share my screen. And hopefully we can see that. All right, good to go. Well, Bookkeeping 101, bookkeeping basics and tips for business owners. So happy to be here to share a topic that is very near and dear to my heart, and hopefully would be a topic that you grow to love as business owners, or at least appreciate as business owners and entrepreneurs. All right, so Warren Buffett says, accounting is the language of business. Accounting is the language of business. So those are Warren Buffett's initial thoughts on bookkeeping and accounting. But think about, what are your initial thoughts when you first start thinking about accounting and bookkeeping? I don't know if you want to share that and pop it in the chat or what have you, but what are your initial thoughts when you think of the accounting aspect of doing a business? Because like it or not, it is here to stay. It is here to stay. And I heard another quote that said, whether you think you can or you can't, you're right. So it's like it starts in the mind. It starts with the attitude of the mind and how you approach the accounting aspect of the business. So as business owners and entrepreneurs, especially if you're a one man, a one woman shop, and you have employees to do the technical aspect of it or the operational aspect of it. But when it comes to the C-suite, we often are it. You know, we have to put on the CEO hat and handle those visionary aspects of the business and the strategic operation aspects of the business. And then we have to put on that COO hat and think about the day-to-day operations of the business. One hat that I struggle to put on, but I realize it is something that I have to wrestle with, is that chief creative officer, or this chief marketing officer aspect of it. Just as being a left brain type of person, that marketing, design, creative part of it oftentimes is a struggle, but I have to put that hat on every now and then to run that aspect of my business. So I set aside some time and I work on that aspect, the marketing aspect of the business. But also there is the CFO part of the executive suite. So you have to think about, as a business owner, if you're a one-man shop, not unless you hire a bookkeeper or accountant to handle it, you have to from time to time put on that CFO hat, that chief operating officer hat of the business. And hopefully you'll gain some tools or some insights today that makes that time of putting on that CFO hat not as grievous or difficult. Hopefully we'll give you some tools to make things a little bit easier. So like it or love it, like it or hate, love it or hate it. If you're going to be in business, you have to at least learn the language, and accounting is part of the language of business. All right, let's go. Today, we're gonna try to touch on these three areas. Hopefully we can get all three. If not, We'll see what we have to do, but we're going to at least try to talk about the 3 different aspects of the bookkeeping or accounting cycle. So the first aspect I like to think of is the gathering financial documents aspect. And then there's the recording, the financial transactions, and then preparing financial statements. We're going to try to touch on those 3 aspects of the bookkeeping or accounting cycle, and some tips and tricks on each one of those aspects. And we're going to pause in between each aspect or each objective, just in case you have any questions. And Hope has graciously said she'll help with filtering the questions. All right, so just to back up a second, we're talking about business versus a hobby. The difference between a hobby and a business is an activity that you operate to make a profit. We see, the knitting, the yarn and the knitting tools there. We see the camera there. If you do those things as hobbies, that's one thing. But once you begin to engage and begin to invest more into that activity and begin to sell it to customers, now you're beginning to think about making a profit, and you're beginning to form an actual business. And when the IRS looks at the factors when determining whether an activity is a hobby or business, there's 9 factors. That's a link that I provided there. If we share the slide, you'll be able to have that link. But it looks at 9 factors when we want to consider whether an activity is a hobby or business. And the very first one of those factors is if the taxpayer maintains a complete and accurate set of books and records. So whether you've been doing something for years or you just started out to make some extra money, or you're a full-on business owner, you have to decide on what you're going to do with the bookkeeping aspect of the business. That's one of the first factors that the IRS looks at when it's determining whether an activity is a business or a hobby. Now, the major tax difference between a hobby and a business is that if you have expenses that exceed your income and it's a hobby loss is not deductible on your tax return. It's just a hobby. You can't deduct that as a loss on your tax return. But if you're conducting in a business and your expenses exceed your revenue and you incur a loss, those losses are deductible on your tax return. So you talk to your accountant professional and they'll let you know what to do with those losses. And in a year like this, where many business owners have their revenue has taken a huge hit, lost 50 to 75% of revenue. A lot of businesses are going to incur some losses. And when you want to report that as a loss on your tax return, I don't want to go too deep in the weeds. You want to make sure that you have books and records. Okay, that's my little spiel. I have a background with the Internal Revenue Service, so I'm going to get off of my my little spiel there. I'm making my little all right, hold on. I'm sorry. It just something popped in my screen. All right, so that was my little soapbox about hobby versus business. That first aspect that we talk about in the bookkeeping cycle is gathering financial documents. Gather financial documents, and we call that pre-accounting. All right, so pre-accounting defined is the system through which financial data, and we're going to define financial data, but it's the system through which your financial data and documents are gathered, they're sorted and coded, they're totaled up, and then they're normalized into a system through which new financial data can come through and go through that same process. So if you look at the picture on the screen, you have just a stack of papers with folders, and you're shoving all your financial documents in folders. That's one way to do a system. But if you wanted to have a clear-cut bookkeeping system, you want to make sure that you have a system through which all your financial documents are gathered, they're totaled, they're categorized as to what they are, and they're normalized in a process. And let's talk a little bit more about that. Types of financial documents. So you can either have a paper system, or you can have an electronic system. With COVID, a lot of businesses are forced to embrace technology and embrace a virtual and cloud-based or digital way of doing things. So if you want to have an electronic filing system, it could be as easy as having a folder on your desktop and having a folder for each month within that business folder, and shoving or filing all of your invoices and bank statements and receipts in a folder on your desktop. If you want to go cloud-based, you can use your Google Drive, or you can use any type of app. There's various apps out there that can electronically file and record all of your financial documents. Like QuickBooks is an accounting system, but they also have a filing system. Receipt Bank, Expensify, those are other ways that you can electronically file your documents. If you want to stay with paper, it's fine, but make sure that you have it organized. We were having a conversation with Hope, and we were talking about having things ordered and structured, and everything in its own place. So the same thing with the financial documents. You can have folders per month or per vendor or alphabetical. Make sure you have cabinets, boxes, storage bins, whatever you can do it whatever way is most comfortable for you. But the important thing is that these financial documents that we discuss are in a systemized way that you can reach back and retrieve them if you need them, or your accountant or the IRS needs them. All right, so some basic financial documents are your bank statements, your credit card statements, any type of loan statements. To just hone in on that bank, hopefully as a business owner, you have a separate bank account or 2 or 3, whatever you need for the business, separate from your personal account. You want to keep that completely separate and have a bank account in the business name. This is for, I mean, it's beneficial for a number of reasons. The first one being, it's good to have all your business transactions in one place. So if you have a business bank account, everything would be in one place. But also, if you have incorporated or you have an LLC, you want to make sure that there's not any intermingling between the business and personal funds, because your business is a separate legal entity. So it should have its own books and records. And if you want to pay yourself, you can distribute your money, or you can pay yourself and pay into your personal account, but it's not a good idea to have intermingle your personal and business funds. Hopefully you already know that, and it's just a reminder. But yeah, so those are some of your basic financial documents: bank statements, credit card statements, loan statements. If you purchase any assets, you want to keep those invoices. You want to keep any receipts. If your business is involved in any type of real estate transactions, you want to make sure that you have those documents. If you have a lease agreement, you want to make sure that you have those handy so that you can get to them when you need them. And on the expense side, keep all of your bills, receipts, and your canceled checks. These are the financial documents that you need to have in an organized and structured fashion. And so you just have to think through, how are you going to organize and file these financial documents? And a question that I often receive is, how long do you keep them? The general rule of thumb is that you keep these financial documents 3 years from the date you have filed your original return. So for 2020, you're going to file that return on or about April 15th, 2021. So you want to keep those documents 3 years from that date. So the 2020 documents, you want to keep them at least until 2024. It's a general rule of thumb. All right, other types of financial documents. On the income side, of course, you have your invoices, sales receipts, deposit slips. If you have a point of sale system, I don't know what types of businesses or business owners that you have here, that we have here today, but if you have a point of sale system, those systems can generate revenue reports that you can keep and you file, and you need them in order to prepare maybe sales tax returns, or prepare your own personal or business tax returns. You want to keep those point of sale reports nearby. I don't generally recommend that you use something like a Venmo or Cash App for business, but if you do, make sure that it's separate from your personal and that you have a way to download all those business transactions. And if you are a contractor and someone pays you more than $600 within a calendar year, they usually will, or they should, issue you a 1099, a 1099 MISC or NEC for 2020 and beyond. You want to make sure that you keep those financial documents nearby, so that when you report when you prepare your own books, or you provide these documents to your tax return preparer, that you know exactly what you made throughout the year. And there is, compliance software that is used within the Internal Revenue Service to determine whether those 1099 reports are reported or included in your tax return. So you want to make sure you don't throw those away, you don't shred them, you make sure you keep those and file those so that you have those when you need to prepare your tax return. On the expense side, you want to keep any type of sales receipts for expenses that you incurred for the business. If you incur business expenses through PayPal or Cash App, again, keep all of those records. Make sure that you're able to file those. Any type of bills for utilities or any vendor bills, say if you have a Staples account or some other kind of a Quill account or an Amazon account that you usually go to pay for business expenses, make sure that you have a filing system to store those records, and also those canceled checks. And with the Internal Revenue Service, we usually still do ask for canceled checks as proof of payment for an expense. All right, I don't know if we have any questions, but I'll keep on going through. For the expense side, what can you deduct? There's two general classes of expenses. The first is the cost of goods sold. And the cost of goods sold refers to those direct costs that are incurred in producing the goods that are for resale. So if you actually make or produce, we looked at those, the knitting tools in the beginning of this presentation. If you actually make garments for resale, everything that goes into making those garments, the yarn, the t-shirts, the threads, everything that goes into producing the product for resale, that's part of your cost of goods sold. Or say if you resell products, say if you own a convenience store, or have some kind of e-commerce business, the goods that you purchase for resale, that's actually called a cost of goods sold. So you keep those separate from your other expense accounts, because those costs are used to deduct directly from revenue to determine your gross profit. So you have your gross revenue, that's all the money that your business makes, and you subtract out the cost of goods sold, or the cost in producing or selling or providing those goods for resale. That's your cost of goods sold. Well, your revenue minus your cost of goods sold is your gross profit. That lets you know how profitable it is. It's a good tool. Don't want to go too deep in the weeds, but it's a good tool to determine whether you're pricing your product correctly. If you have costs that exceeds your revenue, that may mean that you have to increase your price. That may be something going kind of a bit deep into it, but these are ways. This is one of the reasons why developing a bookkeeping or accounting system is good for even your own internal use, because you can determine if you're charging the right price for goods that you resell. Any type of direct labor, even us that are in the service industry, we have cost of goods sold. So as a bookkeeper and a bookkeeping business, the salary that I directly pay my bookkeepers are part of my cost of goods sold. It's directly related in providing that service to the general public, to my customers. The salary that I pay, the cost that I pay for my CPA to prepare tax returns, as a bookkeeping business, that's part of my cost of goods sold. So if you're in the service-based industry, you may have direct costs that are related to providing that service to the general public. That's part of your cost of goods sold. And it's a good measure to see if you're making a gross profit in offering that good or service to the public. The second class of expense, other than cost of goods sold, are just your other operating expenses, and they are varied. Salaries or wages for various other employees of the business. If you're paying any contractors, that's another expense. If you're paying money for advertising, say if you're running a Facebook ad campaign, or you're paying money for your Zoom subscription, because we're all on Zoom nowadays, and you may have to have a Zoom subscription or a MailChimp subscription or any other subscription or cost that is involved directly related to running your business, that those are deductible business expenses, and you want to keep a record of those expenses. If you're in a location and you pay rent expense for the business, keep that. Any interest on any loans, any taxes that the business owes, any insurance. Another operating expense is the business use of car and the business use of the home. So for your vehicle, if you have a vehicle expense and you have to use your car for business purposes, you want to track the mileage that you incur for business travel versus your personal travel. And for automobile expenses, there's two different ways to deduct that. Either you can take all of the business mileage that you incur for the year, so that going to meet your clients or going to jobs for your business, you take total up all those mileage, and you multiply it by your standard mileage rate, which the last time I checked was, I believe, 57.5 cents. So either that's one way of doing it. Take all of your business mileage and multiply it by the standard mileage rate for the year. The other way is your actual expenses. So actual expenses is the actual cost for your gas, for your oil changes, for your repairs, any type of other business expenses, any type of tolls or parking fees that you pay related to your car. You total that up for your actual expenses, and then you take the percentage that you use for business purposes, the percentage of business miles, you multiply that times your actual expenses, and that is another method to produce your car and truck expenses. Those two different methods. If you have any questions, you could definitely chime in on that. But those are two different ways you can deduct your car and truck expenses. And usually you would take the one that is most beneficial to you, so that has the biggest deduction. Business use of home is similar. If you have a aspect or a part of your home that's used exclusively for business, then you could take a percentage of your you could take a percentage of the your utilities for the home and any repairs, and percentage of the purchase price of the home for business use of home. And that has tax implications, so talk to your accountant about that. Okay, so that was the first aspect, or the first phase of the business cycle. That was just gathering the financial documents. Do we have any questions so far on that first aspect of the presentation? You can just drop them in the chat, and if not, then we'll move a little bit further. All right, so the second aspect of the accounting or bookkeeping cycle is recording financial transactions. For recording financial transactions. And this is, we talked about pre-accounting, this is actual accounting. And of course, if you want to talk about accounting, let's define it. Accounting is the theory or system of setting up and maintaining books for the business. Of course, with accounting, we have some mumbo jumbo and we have some jargon that we like to define, but I won't go too deep in the weeds, but this is needed in order to properly record your financial transactions. So we talked about all the financial transactions that may occur in the business. This accounting jargon is going to help us understand how to properly categorize that. Okay, so basic accounting terminology. Assets. This might be something that you already know. So if you already know what are assets that are related to your business, you can drop them in the chat, and we can just kind of go on based on what knowledge that you already have. But just a general definition, the assets are the assets of a company represent the resources that are owned by the company. So these are things that your business actually, a value that your business actually owns. Um, and they are used in conducting the business operations. So the most basic asset that your business owns is cash. So the money that's in your bank account, that's an asset. The money that may be in any type of savings account for the business, that's an asset. If you have any investments that the business has invested in, that's an asset. If you have purchased inventory to resell to the public, that is an asset. That's something of value that the business owns. If you have if you invoice clients and you say you perform service and you invoice them and say you give them terms of maybe 30, net 30 days, that creates an accounts receivable account, which is in fact an asset. Earlier today, I believe the presentation was on intellectual property. So if the business owns a trademark or some other kind of copyright or something, that's an asset of the business. This is something that the business actually owns of value. If you have a location and say you had to fit out the location in order to open for business, and it's called leasehold improvement. So you had to maybe build some cabinets, or you maybe had to remodel something within the place that you're renting. That's a leasehold improvement. That's actually an asset of the business. If you own maybe your computer, the business owns a computer, any type of furniture or fixtures, any type of things that are in your location that the business owns, that is an asset. All right. And then from there, we also have liabilities. This is what your company owes to its creditors. It's reported as a liability. And these items, all these three items here, assets, liabilities, and equity, they're all on the balance sheet of your business. So the liabilities, again, are the debts that you owe to the creditors. Say if you have an account with, again, like a Staples or an Amazon or business account, and you have terms where you don't have to pay up front, that's an accounts payable. That is a liability. Say if the business this year, the biggest, one of the biggest tools that business owners were able to tap in this year is those government loans. If you have an SBA loan, or if you have a paycheck protection loan, a PPP loan, that's a liability of the business. If the business also has a credit card, that is a liability of the business. If the business owes maybe sales tax or payroll tax or any type of income tax, that's a liability. That's what the business owns. So you have what the business owns, which are assets, and what the business owes, which is liabilities. You subtract the liabilities from the assets and you have equity. That's the difference. That's what you as an owner have as value left that is retained in the business. And this is why I love the asset. I mean, I love dealing with, the profit and loss is very useful in making business decisions. So is the statement of cash flows. It's important to know cash coming in and out. But when I really want to know the value of a business and its ability to thrive going forward, I look at the balance sheet. The balance sheet tells me what the actual net value is of inequity in the business. What they own as asset minus what they owe as liabilities is letting me know the genuine value of the business. So just as in this day, just as maybe a home ownership may be a tool to create wealth for an individual, your business is a way to generate wealth, and the wealth or the value of the business is determined in its equity. What it has left, its assets minus its liability, is its equity. And this is something that, say, if you have an exit strategy in the future where you may want to even court investors, or you may be looking to sell the business, the balance sheet, I'm spending a little bit of time on this because the balance sheet is important in terms of it's properly classify your assets, liabilities, so that you can determine what the actual value is of the business. So maybe when you have that profit, the business is profitable, you can maybe reinvest it in assets and increase the value of your business. Okay, so that's the balance sheet. And let me know again if you have any questions. All right, so we'll move forward to, again, we're talking about basic accounting terminology. Now, these two items are on your profit and loss. The previous slide talked about the balance sheet. These items are on your profit and loss or your income statement. And of course, that's your revenue. Your revenue is the money that you're making. You're selling products, you're offering service, you're generating some sales revenue. Yes, bring in that money. So you generate, even as a nonprofit, if you receive grants or you receive donations, those are inflows of cash. And you want to make sure that that is properly recorded as revenue. Maybe you have some rent income, you're subleasing your property, or maybe you got some dividends or some interest income. Make sure that you properly classify and record the revenue streams of your business. Revenue, another term of it is income, another term that is used as sales. These are all inflows of cash in your business. And then expenses, we talked about a little bit earlier when we designated cost of goods sold and expenses and other expenses, but those are outflows of cash. All right, and so those are the general ones that we talked about: salaries, utilities, rent, insurance, office supplies. Here again, it depends on the type of business that you have that determines the type of expenses that you may have. So your revenue is your inflow, your expense is your outflow. And if your revenue is greater than your expense, you have net profit. And if your expenses are greater than your revenue, you have a net loss. And that goes back to the beginning when we talked about if you have a net loss as a hobby, that's not deductible. But if you have a net loss as a business, that is deductible. And there may be some tax strategies that your accountant may use with that loss. Okay. Let's move forward. We're still in that second phase of the accounting stream, but we're going to talk about now your accounting software. Now that you have the accounting data, the accounting documents that are coming in, and you know how to properly classify them, what are you going to use to actually record those financial transactions? So there's various accounting software choices out there, and it always depends on what your needs are. Again, if these slides are made available, some of these links are hyperlinks. They go to the various websites. QuickBooks is one of the most popular ones that is used accounting software. These are cloud-based accounting software. So basically what that does is it uses your business bank account, your credentials, your username and password for your online business bank or your online business credit card. It synchronizes with one of these cloud-based accounting softwares. It downloads those transactions, and you, based on your accounting knowledge that we just went over with the assets, liabilities, equity, revenue, and expenses, you classify those transactions. So instead of just looking at your blank or looking at your online banking data and your transactions, you now know what those items are and how to classify them. So if you pay for supplies expense, you want to classify that as a supplies expense. If you have a loan payment is not an expense. A loan payment reduces your liability. So it's important to properly classify these items. If you receive a loan, money coming into the bank account, it's not revenue. You don't want to classify a loan as revenue because then you have to pay tax on that. A loan is not a taxable income. You want to make sure that you classify a loan as liability, but it's coming to your bank account and you have to tell your accounting software what to do with it. So when you have money coming in, or even if you invest your own personal money, that's equity. So you don't want to count that as revenue. It's hitting the business bank account, but you want to count that as equity, not revenue. Again, this all makes a difference. I hope you understand why we had to go through that accountant lingo and mumbo jumbo, because we want to make sure that you properly classify these items so that when it comes time to prepare your tax return, you're not overpaying taxes because you misclassified a transaction. Again, so the accounting software that's out there, you have QuickBooks Online, you have FreshBooks. Wave is a free accounting software that I generally recommend if you don't need complex accounting transactions. So the limitations may be if you want to track sales tax or inventory, you don't want to use a Wave. But Wave generally, it can invoice, it records your transaction, it can generate basic reports. That may be a way to start if you're not comfortable paying for a cloud-based accounting software. Another accounting software is Zero. That's another one it's popular out there now. Or you can use your old trusty, dusty, handy Excel template. I mean, I've worked with clients this week that they use an Excel template from long ago. And if that works for you, fine, but make sure that you're properly classifying everything that comes in and out of your business as either asset, liabilities, equity, revenue, or expenses. So based on your accounting needs, you want to do some research and determine whatever accounting software works for you. Or if you want to use paper and pencil, that's fine. That's fine. You can do that. There's no law against it. But your accountant may want you to scan it and send it or what have you. But whatever way you do, the point is in this aspect is that you want to make sure that you properly record all your transactions. So spend some time, even though putting on that CFO hat maybe not your favorite time of the week or the month, spend some time during that time thinking about how you're going to properly classify your business transactions. All right. So that is the end of the second aspect or phase of the business cycle. Do we have any questions that have come in? Hope at this time you can just interject and let me know if we had any questions that came in.
If anybody has any questions, feel free to put them in the chat. Dave made a really good point. He said in the chat, if you are an early stage startup, it's really critical to understand your burn rate, how much money you spend monthly, the cash on hand, how much cash you have in the business, and your runway, how many months you can survive financially based on the amount of cash on hand. That was a really good
very, very, very good. And if you're not familiar with those terms, the cash burn rate and things like that, you can Google it. And there's various spreadsheets out there that can compute your burn rate. So you have money in the bank, and you want to determine how long it's going to take based on your history of financial transactions. You want to determine how long it's going to take or how long that money is going to last. It's a good idea to know about your cash burn rate for sure. For sure. All right, the last section that we have, and then we'll wrap up for the night, is prepare your financial statements. And this, we talked about pre-accounting and we talked about accounting, and now this is a term called post-accounting or financial reporting. Financial reporting defined. Financial reporting is the financial results of an organization that is released to your stakeholders and to the public. Other uses for financial reporting is your own internal use. Again, talking about that cash burn rate, talking about the profitability of offering your goods and services. Make sure that you are priced the right way. You need your financial reports for that. During these months, as I helped business owners apply for loans and apply for grants and funding, the financial reporting, I'm telling you, that was very, very important, because a lot of these loan applications and grant applications, they require you to pull that data from your financial reports, your balance sheet, your profit and loss statement, to determine the need. The business need for the loan or the business need for the grant. So financial reporting, yes, is used for the public, but it also can be used internally as well. Financial statements, they tell the story of your business or your organization. So you've gathered your financial documents, you've recorded those financial transactions. Now your financial statements allow you and others to summarize, analyze, and evaluate the business's financial health. They tell the story of what has gone on in your business throughout the year and throughout its existence. Um, and you can evaluate the health of your company or organization by reviewing and reconciling your reports regularly. Reconciliation is basically comparing what you have in your business bank statement or your business credit card statement, comparing that to your accounting records. So whether you're using a QuickBooks or whether you're using another accounting software, you have to you usually want to compare regularly on maybe even on a monthly basis or more frequently, if that makes sense for you. You want to reconcile and make sure that what's in the bank or what has occurred in the bank is properly reported in your accounting software. Again, we're going a little bit deeper into the usefulness of these financial statements. Again, they're useful for you as the owner or manager, also may be useful for your potential investors, creditors, advisors, and others. So financial statements can be used to gauge your performance. It's good if you have an accounting software and you want to run comparatives. So you may want to run your comparative with this month compared to last month, or this quarter compared to last quarter. And those comparative reports will help you to gauge your business performance. A lot of the reports that we've been running again for these loan applications, we compared this year's performance to last year's performance, and we were able to document any type of change in business performance or the need for funding. So these financial statements, they're used to gauge your performance. You may want to going deep and use these the financial documents to calculate your return on investment or ROI, to determine again, if you're running a profitable endeavor, or you can even break it down to certain lines of businesses and determine whether a certain product or a service is profitable. Financial reports are used for making pricing decisions and making other business decisions, whether to allocate resources. Listen, if you have a product line, many businesses had to determine whether certain product lines are profitable and if they could be survivable going forward. And in order to make those business decisions, you need business document, you need the data, and these financial statements are useful in that regard. They also can be used to assess your consequences of certain business strategies. So maybe you ran some kind of ad campaign for the month of October, and you want to see how that affected your revenue. So you want to you look at how much you spent on advertising and you determine how that affect your revenue or your profit and loss statement. And you assess, or you may, when any type of ad campaign or advertising, you want to assess it over a longer period of time. So you take a look and see if this is a worthy investment, but you need your financial statements for that. And we've already talked about financial statements and determining credit worthiness. And many financial statements or lenders may request that you submit financial documents. So they are going to ask you to submit your profit and loss and balance sheet, maybe on a quarterly or annual basis. Talked about the balance sheet already, and that accounting equation is what makes my heart smile, because it always has to balance. Assets have to equal liabilities plus equity. I mean, that is the thing that keeps me sane, knowing that in the accounting world, there must be balance. Asset must equal liabilities plus equity. Balance sheet as a review shows what you own as assets, as well as what you owe. And the difference between that is equity. Balance sheet, that first bullet there, it tells you your financial position at any specific date. All right, so say if you've been in operation for 3 or 5 years or so, your balance sheet is going to show your history. And say if you ran your balance sheet as of June 30, 2020, that's not just going to show the year, but the balance sheet shows accumulation of the value that has been retained in your business. Again, that's one of my favorite statements. I know that cash flow and all of that is very, very important, but the balance sheet shows the financial position at a specific date. All right, this is just a balance sheet that is split in two, but it shows Craig's design and landscaping business as a fictitious business that QuickBooks often uses as a demo company. But you see there those list of assets on the left and the list of liabilities and equity on the right. And again, if you have any questions or comments, you can chime in. Just a typical balance sheet to let you know or trigger some things in your mind of some assets that you may want to think about or recording for this year as the year begins to round up and you begin to think about what occurred throughout the year. Take a look and see if you purchased any of these types of assets or incurred any type of liabilities or infused any type of equity into your business. Simple balance sheet. Income statement is the revenue and expenses, and the difference between that is either net income or net loss. They're prepared at a specific period of time. So you compare income statement or a profit and loss statement on an annual basis, quarterly basis, monthly basis, weekly basis, whatever. However often it makes sense for you to run the profit and loss and look at your numbers. People like me that looks and loves numbers all the time, I'm looking at those numbers every single day. And the equation that goes on the income statement, of course, simple: revenue minus expenses equals net income or loss. Here's an example of Craig's design and landscaping profit and loss statement. He is a landscaping business, of course, but he also offers some other types of services. So you see his different revenue streams that he has there: design income as well as some landscaping services, and he breaks it off. He breaks down the income in specific aspects of those revenue streams. Cost of goods sold is right under total income with a gross profit there. And then after that are the operating expenses. So just triggering in your mind any type of expense that you may have occurred this year as you prepare to round up the year's end. Think about have you incurred any additional legal or professional fees for this year? Have you paid a contractor and you've paid them over $600? You may be required to issue a 1099 at the end of the year. So let's think through some of those things. Profit and loss is the statement that's going to be used that you're going to give to your accountant to determine the tax, to prepare your tax return. So if you're a sole proprietor or a single member LLC, you're going to prepare a Schedule C on your tax return. And that net income or net loss figure is what's your tax preparer is going to use to generate that statement. If you have multiple owners, then you'll split that amongst the owners of the business. So if you have 50-50 owners, you would split. In his case, he has a $2,900 loss. He would split that amongst the owners. If it was 50-50, he'd split that in half. If there was a different ownership percentage, he would split that amongst the owners, respective of their ownership percentage. All right, tail end, we're going to wrap it up with some bookkeeping practices and then open it up for questions. So if this makes sense for you, I've prepared a one pager with QuickBooks bookkeeping task, and I can provide that and have it available. But then I just put it here on some slides. If it makes sense for you, or however frequently you want to do these tasks, these are some items that you might want to check in on a regular basis. Maybe on a daily basis, you want to check your money in and your money out. Any invoices that are paid or any expenses that you paid during the day, you want to make sure that you record those. If you have an accounting software, download those big banking transactions and begin to classify those in their respective categories. At the end of the day, it might be a good idea if you want to issue your invoices at a particular time of the day, or issue your estimates if that makes sense for your line of business. Also, you want to record assets and liabilities while that information is fresh in your mind. So if you went out and you purchased a new laptop for the business, you want to make sure that you're going to record that pretty much that day or around the time, because I sit down with business owners all the time and I ask, what's this particular expense for? And it could be just a week ago, and they have the hardest time recalling what they actually spent the money on. So you want to kind of record those transactions as they're fresh in your mind. There's so much life happening. I mean, there's so much life happening. So you want to make sure that you can record those transactions um, as frequently and as often as it makes sense for you. Again, putting on that CFO hat for your business, maybe some of those weekly tasks. If you have payroll, if you have employees, let's make sure your employees get paid. Let's run that payroll. You also want to keep an eye on any unpaid invoices that may be in your accounts receivable. Is it time for maybe to send some reminders that are some unpaid invoices? Is it time to maybe pay some bills that have been unpaid on a weekly basis? Let's keep an eye on those types of those items. Within QuickBooks, they have the ability to add and edit vendors and customer profiles. So it may make sense if you had a new vendor, a new customer that's this week, you may want to add that into a QuickBooks or your accounting software. Same thing with products and services. They offer that functionality to separate that within QuickBooks. And again, you want to keep your eye on that banking feed and record and categorize those incoming transactions. So if you have a weekly time during the week where you want to put on that CFO hat, here's where you would check in with those weekly tasks. On a monthly basis, bank and credit card reconciliations. This is something that I just nail home all the time. You can find missing expenses or revenue or things. Sometimes your accounting transaction, you may have missed something. You may have missed something in your accounting software. If you run those reconciliations, you make sure, again, you check what happened in the bank and credit card statement happened in your accounting software. It may be good to even look at those credit card statements and run those reconciliations. You may find errors. Maybe your credit card company or your vendor double charged you. And you can discover that if you run your reconciliations on a monthly basis. Reconciliations, I can't hammer that home enough. It's one of those tasks that becomes easier as you do it more frequently, but you can discover some really big errors as you record those reconciliations on a monthly basis. Monthly basis may be a good idea to run your profit and loss report and the previous month, and make sure that you're recording all your income and expenses. Within QuickBooks, they offer this functionality of creating an account called Ask My Accountant. So if you don't know how to classify something, you can just dump items in this Ask My Accountant category, and then during the month, reach out to your bookkeeper, reach out to your accountant, reach out to someone, ask a question on how to record that transaction. Lastly, I believe it's on a quarterly basis. You want to make sure that if it applies to you, you complete those payroll tax filings and estimated tax payments for yourself as an individual. If you are the type of business that collects and remits sales tax, you want to make sure that you file those sales tax filings on a quarterly basis or monthly, depending on the amount of sales tax that you collect. On a quarterly basis, you want to keep an eye on those vendor reports and make sure if you're paying someone and it looks like that you'll be paying them over $600 during the year, you want to collect a W-9 from them. And that W-9, the IRS form W-9 just collects their name, their address, and their tax ID number, whether it's their EIN or social security number, just collects that information so that at the end of the year, by January of the next year, you're required to issue those 1099. So run those vendor reports, keep an eye on it. If you have a go-to vendor and they're not a corporation, there's an individual that you're paying, and it looks like that you're gonna pay them over $600 in the year, you wanna collect that W-9 so that you can remit the 1099 at the end of the year. Quarterly, you may want to check in with your accountant and answer any questions ask any questions that you may have of your accountant. Speaking of any questions, does anybody have any questions for me? If not, I'll just put my contact information on, and you can reach out if you need me. All right, Hope, I'll turn it over to you if there's not any questions.
Yeah, everybody, thank you so much for coming. Thank you, Katishia. This was so great. And, you know, I just wanted to say it's so exciting to see with the passion that you speak about a topic that really just stresses me out so much. And so it's so nice to see that you simplified it so well. And I felt like really inspired me to not be so stressed about bookkeeping and accounting. So thank you for that. I appreciate it.
My pleasure.
Does anybody have any questions before we wrap up? Feel free to unmute yourself and ask. Speak now or forever hold your peace until you may reach out to Katishia later. Well, thank you all for coming. My email is hope@valleyventurementors.org if you like to connect with me further about other workshops that we have, or you'd just like to connect, give me some feedback, give EVM some feedback. Thank you so much again for joining us and for giving us this wonderful Bookkeeping 101. We're so appreciative.
Thank you all. Good luck with your business endeavors.
Thank you.